2 is what we call the shift coordination. And also we are going to study about the liquidity agglomerations. So this is the very, very important topic. You have to, because if you're able to master this topic, actually you can trade in any of the market conditions, any of them.
Okay.
So you have to be keen, you have to be careful. Also, I may need your attention, focus, so we can break this down. Okay. So actually, when we on this phase 2, that because if you manage to reach this phase 2, means that you have already passed on those indomitable, on those validation violations. So now we are going to talk now on maybe if what the market does when the market now reverses, because we actually know that how to deal with some validations and evaluations that just like this. But now when the market now reverses on some certain case scenario like this one, what are we supposed to do? Now this is what we call the market shift. The market shift is a process of market breaking both higher highs and both higher lows. So when the market closes above the weak point that is presented by the market on this exact point here, then after the market breaks again on these weak points that are actually presented on the same certain case like this one, now this is what we call the shift coordination, or we call it the market shift. So how do we spot this shift now? Let us see how do we spot this shift. First of all, if you want to spot the clearly shift, first of all, on this bullish case scenario, you have to observe the lowest point, the lowest of the lowest point. So if I actually come in this chart now, this is my lowest point of them all, as you can see here. So after spotting this one, now I'm going to the left side. Then after, I'm going to find the structure that was being broken to the lowest point, the previous structure. Then after, I'm going to find the point where the market now came in closed above that weak point. So as you can see here, this was my structure. The market closed below this structure, as you can see. Also, the market closed above on this certain point here on that specific week. So now this here is my shift point. So now I can officially say that this price is no longer a downtrend. Now the market is going up. Are we clear to that point? Or if anything that
yes, we are.
Yes. Another example, let us to look at this example here. Now I observe the lowest point. As you can see, this is my lowest point. If I come to the left side now, this was my structure that the market actually broke from this point here below. As you can see, also the market came and closed above by the, what we are considering here is the candle closure. So as you can see now, this was my place where the market came in, closed above this point. Now we can see now the market has already shifted, and this is our shift point. This exact point here is our shift point. Another example, if you observe clearly on this bearish scenario, we had this as our highest point, as you can see here. But if I come now, previous, this was my latest structure, the structure that actually was the market closed above it, also the market closed below it. Now this is the point where I can term it as my shift point, because it's an area where the market closed prior to the previous structure, as you can see on that illustration. Another example, you can see on this bullish case scenario, we are this lowest point. So if I come to the left side now, this was my last structure to be broken. The structure was broken down as you can see on that previous weak point. Also, you can see the market closed above. So as the market closed above now, this is my shift point, as you can see here. So that is how we spot these shift points. Another example, as you can see here. So what you have to bear in mind is that you have to observe that highest point. This was my highest point. But a lot of people are mistakenly, because they observe the closure, the highest closure. But if you want to trade the perfect shift, you have to observe the highest point that the market actually went. And this was my highest point. And we're actually observing the highest point because we are to be assured that we are actually shifting on each and every time frame. because if you come to this point here on lower time frames, you can see the candles from 1 minute time frames actually rallying like this. So we cannot say that this is my shift point, rather because there are some structures that actually on one minute time frame that are above on this area right here. So that's why you consider this highest point. Then after we come to the left side to see if there's a previous structure, as you can see here, this was my previous structure. Then after the market came in, closed below that previous. So now this is what it is, my shift point. Another example, we have a lot of examples. You can see here the market was formed this low, then after the market came and closed above this structure that was marked by the red rectangle. As you can see here, the market came and closed above this point here. So now this is my shift point. That is my shift point. As you can see also in this example right here, the market came down. Then after my previous structure was this one, this single candle, bullish candle. After the market came and closed above that candle. So now that is my shift point. Another example, as you can see here, now this is how we observe those shift points. If there's any questions so far before we continue.
No, sir, I totally understood everything.
Okay, so you'll find me almost 15 examples of how to spot these shifts. You can mark the shift point,
okay,
like this one, and the previous structure to be that the market liquidated it. Then after you can send me to my Telegram or my WhatsApp, whatever, in a PDF. Yeah.
okay,
So now,
no problem.
after the market now shifts, now this point here, it is what this is not an area of liquidity, but it is our point of interest. So this is not, because my area of liquidity will be found on this exact point. So before I continue, let us go on to see the difference between the break of structure and the market shift. Now this is my break of structure. As you can see here, the market formed a validation and validation point, but when we talk about shift, the market now comes and closes above this point, this violation point. So as you can see now, as long as we call this a violation point, it is now a shift, because now the market has officially violated this area by closing below by a candle closure, as you can see on that exact point. So now this is the difference between break of structure and the market shift. So now let us discuss shift coordination on basic levels. So when the market actually forms the shift like this one, here we say that the market, it is in a transition phase. When I talk about transition phase, that the market now has changed the direction of the trend, but we are not officially, or the market it hasn't confirmed it to us that this is the true trend, or now the market is moving to that exact specific area. But the market has a tendency of coming to this, what we call the point of interest, this area of interest. Now, what actually happens is that on basic level, what we have to observe when we're studying shift, this is just a skeleton. It is not unofficially on how we trade this shift. For example, this orange is my weekly time frame. So now when the market shifts to this weekly time frame, this area that we term it as an area of liquidity, or our area of interest, when the market now returns inside this area, the market also has to shift on the 4 hours time frame. That is the situational time frame of this constant time frame, that is the weekly time frame. So after the market now shifts to this 4 hours time frame inside the point of interest of a weekly, after the market shifts, now we have to wait for the market now to come inside the area of 4 hours again. Then after the market has to shift also, then after we can take our trade, because now all of these 3 time frames are speaking the same language. So now if you take your entry somewhere there, you can actually hold. So as you can see, when you take your entry right here, you are taking an entry based on the risk of 30 minutes time frame, but to the reward of weekly time frame, as you can see. So you can take your entry with very high risk to reward ratio. But this is on a basic level. Now let us first go and see on how this shift is actually categorized. We have types of shift, and these types of shift are actually categorized based on the formations that the shift actually performs when the market is performing that shift. So we have this type of formation. First of all, we have the inside formation only. So now when the market maybe performs a shift, it actually leaves this inside area of liquidity. we actually called it an inside formation because of how the market forms it. So after the market now shifts, it can leave some structures that are actually inside this area of shift. So this is what we call an inside formation. Inside formation. Or by abbreviating, actually I used to call it INF, just like that. So this is my first type or first category of the shift. Then after, so this now is my area of liquidity, as you can see, but also we have both inside and outside formation. So as you can see here, the market, after the market now performed my shift, it actually left me with these formations, inside one and outside one. But now on this case, actually what we have to be very, very observant with is that you have to observe the inside formation if the market has already consumed its liquidity. So as you can see here, we had two formations, but on that inside formation, the market came and tried to grab a lot of liquidity here. So as a result, now the best area of you to trade for right now is this outside formation. But also, you cannot ignore these areas that the market has left on this downward right here. As we actually saw on that assessment on some pairs like AUD-JPY, the market may come and clear this liquidity first, and after the market can go to its normal direction. So these areas also are areas that we have to put into consideration. Or because maybe when we have this area of liquidity as 100%, as you can see here, after the market tried to consume this one, it actually consumed maybe to 55%. So there's some 45% that are actually left on right here. So we can consider this one, but also we can consider this our outside formation as the best area of liquidity to trade at the moment. So now, if now our inside formation is a fresh level, the market also has a high probability of coming to this inside formation. Then after it can tap maybe to some entries, then after the market can continue to move to its original directions. The third type of formation is actually what we call the outside formation only. This is just like that. Maybe it's like the inside formation, because now you have only one area of liquidity to consider, and now this is the area of liquidity that we're actually considering. And after we will see on how to deal with that. If there's any questions so far before we continue.
No, sir, there's no question so far.
No question. Okay.
Yes.
So now that was just the basic on how the shift actually has to appear, because the shift has to follow that time frame coordination. If we are actually dealing with the weekly time frame, we have to actually deal with the weekly, then after we have to deal with the 4 hours time frame, then after 30 minutes time frame, and so on. But now just go now to see on how we trade this advanced shift coordination. Now, actually, there's some technology that are actually adding on this scenario. We have this, what we call reclaim. As you can see, this is my reclaim. Now, actually, what does the reclaim mean? Reclaim, actually, as you can see on this trend, on this previous trend here, the market actually was performing a bullish, as you can see. Then after, the market performed a shift on this exact point here. So after the market performed the shift, now what this shift signifies is that there are some new participants that are sellers. Actually, the new participants that are trying to press, or they're trying to make this market go down. So this, we call it a reclaim point, because if the market comes and close above by the candle closure, now we term this situation that those bulls that actually we're trying to bullying on this market have reclaimed the opportunity of continuing to buy this trend. So that is actually what we call a reclaim point, because if we now close above this area, it means that these shifts and all of these activities are actually violated, and the trend continues to where it was on those reclaimers are the bullish ones, those bulls that are actually trying to take this market up. But also, as you can see on this example, on this actual illustration, we have this, what we call a transition point, because the market actually shift on this exact point here. But basically, when you are trading shift, basically, actually, as you can see, we have this inside formation, but also we have an outside formation. But in case of confirmation, Actually, I actually do advise this one for those people who are trying or are actually beginning to trade this shift one, this shift concepts. This outside formation is the best area to trade because the market has actually confirmed that we are actually going down. Because when the market just does something like this is just a transition. The changes that are actually happening, but in order for the market to assure us that these changes are actually valid, the market has to perform another area of liquidity. That's now we can use it to go down. The market may come somewhere there, then after you can go down. But I will teach you on how to trade both inside ones and the outside ones. So now what do we have to see? Now, when talking about this concept, now let us go to our first, let us discuss our first agglomerations. So now, for example, the market has performed a shift on our monthly time frame, as you can see here. Then after, the market came and left us our area of liquidity, which is the monthly area of liquidity. Now here, listen clearly. What you have to do on this situation, first of all, you have to observe and mark that area of liquidity that actually you have on that specific time. After marking this area of liquidity, you have to go to the daily time frame on this area right here, on daily time frame, to observe the shift that actually happened on this area right here. So now, when you come maybe to daily time frame, maybe you find something like this one. Maybe this was my shift on daily time frame, as you can see here. But also the market left me a formation, an inside formation, as you can see here. So what you have to do right now, you have to mark this inside formation. You can mark it. Then after, wait for the market to come and tap this area first. But when the market now comes and tap it by the market coming to tap this area, the market has to tap this area. Then after, it has to perform the shift again on that specific time frame, that is daily time frame. So it has to be something like this. Let me show you. So as you can see here, when we came from monthly to daily, we came to observe the shift that was happening on this exact point here. So as you can see, we had this area of that was our inside formation. The market came and tapped this inside formation, but the market again shifted on the daily time frame again. So now this is what we call the confirmation of liquidity flow, and this is our first agglomeration. The market prints a lot of setups like this. So now this is what we call the confirmation of liquidity flow. So the market now has confirmed our flow of liquidity. Then after, the market came and shift again to the daily time frame. So what now you have to do, you have to observe this area of liquidity. Now this is our best area of liquidity to trade, and this is where we're going to take our entries. We're going to take our positions now. So when you come now to 1 hour time frame, you have to observe the liquidity engineering that the market has offered on that specific exact point. Then after, you can put opening order there and your stop loss above that point. Then the market will come in, tap that entry point. Then after, you can continue to move as usual. If there's any question before I go now to real charts. If there's any question, you can unmute your mic. Is there any question?
Okay, so
yeah, tell me.
yes, I have what is agglomeration?
Actually, what agglomeration is just the name of maybe those areas that a lot of liquidities are presenting on that specific point is what we call the agglomerations.
Oh, okay.
Yes. So now let me move.
Let
me share my screen.
Okay.
To my trading views, that we can discuss these concepts deeper.
Okay.
Can you see my screen?
Yes, I can see.
Okay, now let us go to GBP/USD first of all. Let us go to GBP/USD. Let us go to monthly time frame. Then after, let me cut this chart somewhere here. So now let us observe something here real quick. So as you can see here, the market was coming up. The market was creating series of highs and lows. But when the market now reaches to this exact point here, the market now performed a shift. As you can see, this was my shift on monthly time frame, as you can see. But after the market now performs that shift, the market actually left me with two areas of liquidity, an inside one and an outside one. But now let us discuss first on this exact outside formation. I usually mark it by red because I actually follow my color codes. Now this is my area where I can actually try to confirm if the liquidity has already confirming the liquidity flow. Then after I can take some positions. So now after the market performed the shift on monthly time frame, then after the market left me some area of liquidity right there. Now I'm going to my daily time frame and observe this area right here to see if there is some shift that the market actually offered. So now if I come to this exact point, as you can see here, I can see there's some shift that the market actually performed. So as you can see here, this was my shift on daily time frame. This was my shift on daily time frame, as you can see here. But this shift now has left me an inside formation. As you can see, this was my inside formation. This one was my inside formation. So that what I'm actually have to do right now, I have to wait for the price to come and tap to this inside formation. Then after, the market has to shift again, just like it did right here. So then after, the market now later on, the market came and tapped to this exact point. Then after, the market performed a shift again, as you can see here. The market performed the shift again, as you can see on this exact point here. So now the area that has actually left this one, now this is my best area of liquidity to trade. These are the areas where I actually put a lot of volume, large lot sizes I actually put on this exact point, because the market has confirmed the liquidity flow by tapping to the inside formation that was formed on that area of liquidity of monthly time frame as my constant time frame. So now if I mark this now as my area of liquidity, I have to come to 1 hour time frame so that I can find my liquidity engineering, so that I can go down. So as you can see here on this exact point, this was my liquidity engineering here. Let's mark it by blue. This was my liquidity engineering. Then after, now the market came and tapped my entry, as you can see here, tapped my entry, and then to a zero drawdown. Now the market goes to the direction that I was anticipating, and the risk was only 19 pips. Even if you put by 15 pips, you are safe. Now the market goes down, the market goes down as possible. This was a swinging entry. It was a swinging entry. The market went down a lot of pips. As you can see, 3,271 pips. So if you are able to hold, you can actually hold this trade. As you can see here, the market went 3,271 pips and the risk was only 15 pips. So this is how we deal with these first agglomerations. If there's any question before I move to my second example.
Nothing yet. So this example is for inside. You said this inside and then you said this outside.
Yes. When you're dealing with these agglomerations, it's better to use these inside formations on that specific daily, that specific situational time frame, as you can see here.
Okay.
Yeah. So you have to, after marking the liquidity of monthly liquidity, when you come to the daily now as a situational time frame, you have to find that inside formation, because this inside formation is the formation that ensures us that all of the liquidity that actually are located on this area are actually fulfilled. Because when the market comes to this exact point, actually it has to fill this area of liquidity, it has to fill this one. So if the market comes again now, fills this area of liquidity right here and confirms the flow by shifting, it's an area now we say that yes, now this market has actually have to go down. That's why we use these inside formations.
So what happens if the market forms a shift but does not leave an inside formation?
If the market performs shift and does not leave an inside formation, we actually don't have to
Yes.
put that pair based on these rules that actually are allocated on this exact agglomeration. We have to deal with it on some certain rules, not this agglomeration rules.
Or not these ones.
Yeah,
Okay.
not these ones. We'll come to see it
Okay, now I'm
on the second agglomeration after seeing this one.
okay.
Yeah. So when I come to another example, let me take what we GBP and ZD. Now on GBP and ZD, let us go to weekly time frame, because the weekly time frame, I use the weekly time frame as my constant time frame. Then after, let us cut this to somewhere here. So now, as you can see, the market was trying to rallying up, but then after the market came and shift on this exact point here. This was my shift on weekly time frame, as you can see here. But then after the market now performs the shift on weekly time frame as my constant time frame, the market actually left me with two formations, an inside one and an outside one. That was this one, as you can see here. This was my validation point on the outside formation. Let me mark it by orange. And this was my invalidation point on this exact outside formation. So what I have to do now, I have to go to the 4 hours time frame on this exact point here and find the confirmation of liquidity flow that I can take my sell. So now if I go to 4 hours time frame, when I come to this 4 hours time frame, as you can see here now, I have to find the shift, and this was my shift that actually performed on this specific time frame. This was my shift, mark it by green, as you can see. And now this was my inside formation, as you can see it clearly. This was my inside formation.
Inside formation.
Yeah. So I have to wait for the price to come and tap to this entry first. Then after the market has to shift again. Then after I can take my entry. So I have to wait. The market actually tried to touch but didn't reach to that exact point. I have to wait. You have to wait. I have to wait. The market now came and tapped that area of liquidity, and the market now performed a shift on this point right here. As you can see, the market performed a shift. So now here, after this shift has already completed, and as you can see, the shift completed on closing below this point here. So now this was my shift point, but after this shift point, the market now left me with these formations, outside one and inside one. Starting with this outside formation, let me mark it now, because this is my best area for it to trade on this scenario, because the market has already confirmed the liquidity flow. So let me remove this line here. So now this was my, so now what I have to do now, I have to go to 30 minutes time frame so that I can find my liquidity engineering, because the confirmation of liquidity has already been done. So when I come to 30 minutes time frame now to this area, as you can see here, there was no clearly liquidity engineering that the market actually performed. And also, as you remember the concept of liquidity consume the market, how the market actually consumes the liquidity. As you can see, this zone actually the market was already consuming a lot of liquidities. So if you spot a situation like this, you have to go to the lower time frame, that is actually the 5 minutes time frame, so that you can find the liquidity engineering that is presenting above that area. So when I come here now, as you can see, the market was actually liquidating itself, as we talked from the previous session. As you can see, the market actually was forming highs like these ones, then after low, then after high, then low, as you can see here. So the market came and consumed this area of liquidity, as you can see there. Then the market came again up, then down, then created an area of liquidity. Then after the market now came and consumed again, as you can see there. So what we have to do on this situation, we have to find the liquidity engineering that was actually above all of that activity. So as you can see here, this was my liquidity engineering above all activities that the market was actually performing here. So now I am putting, this is the area where I have to put my entry, and the risk was almost 6.9 pips, almost 7 pips. So after putting a pending order there, you have to leave it, set and forget. The market later on comes and taps to your entry, as you can see. Then the market now goes down, just like that. Goes down. The market went down almost 362 pips, and the risk was almost 6 pips. And here the risk to reward ratio was almost let me check it clearly. The risk to reward was almost 1:25. But now this pair, I entered this trade, but then after I came again and buy after closing this sale, and I actually bought this pair because if you observe clearly on this constant time frame, if you observe clearly, you can see we have this type 1. You see this biggest type 1 that actually formed here. This was my type 1. But now when I go deep on 4 hours time frame, I had this is what we call the sub area of liquidities. Some areas like this. After the market performed the shift, I actually had these sub areas of liquidity that I actually used to take my buy. Actually, they were located on, it was not on this time frame, it was on the lowest time frame that is actually supposed to be here. So that is how I took the entry. But this is how we trade these agglomerations. This is how we spot a situation like this. If there's any question concerning this pair before I move to the next pair.
Nothing yet.
Nothing yet. Okay, let us go now to the third pair, which is GBP CAD. Okay, it's not a must to use weekly time frame or monthly time frame as your constant time frame. You can also use daily time frame as long as you follow the time frame coordinations and also you follow the liquidity confirmation rules. So as you can see here, the market performed a shift on this point here. Then after, the market now left me with this formation. As you can see, this was my formation that the market actually left for me. Then after, I have to come to 1 hour time frame to find the shift that actually happened on this exact point here. So now when I come to 1 hour time frame, first of all, let me cut this chart so that the data actually we can observe it clearly. Let me try to cut it out. Let me try to cut it out somewhere there. So when you come to 1 hour time frame, I have to find my shift point. As you can see on 1 hour time frame, this is my shift was located on this point here. This was my shift. Then after the market now performed my shift, the market actually didn't leave an inside formation, as you can see. So if the market does something like this, you have to find this inside formation, this outside formation, but you have to observe that this outside formation must not be consumed. So as you can see, this outside formation is clean, as you can see, as clean as possible. So now you have to wait for the price to come and tap to this formation first. Then after, waiting for the market to shift again to the 1 hour time frame, to the 1 hour time frame. So after a period of time, the market came and tapped to this entry, to this area. After the market now taps to this area, you have to find a shift on that specific time frame, which is the 1 hour time frame. And now my shift was located on this area, as you can see here. So now, after the market performs my shift, this was my formation, my inside formation, that was actually the one that contributed to performing this shift from 1 hour time frame. So this is my area of liquidity. So now what I have to do now, I have to go to find liquidity engineering on 15 minutes time frame so that I can take my entry on this exact area of liquidity. So when I come to 15 minutes time frame now, when I come to 15 minutes time frame, and now when I try to find my liquidity engineering, this was my liquidity engineering, and also this was my liquidity inducement, because as you can see how the market was actually reacting. As you can see, the market came, react for the first time, react for the second time. Now this is the best area of liquidity engineering to trade, because actually it gives us a lot of confidence and a lot of confluences. So after putting your entry on that exact point, and your stop loss was almost 14.3 pips, as you can see. Now the market came and tapped to your entry point there. But also, even if you miss your first entry, don't panic. You have to wait for the second entry, which was this one as our indomitable. Now the market came again and tapped my entry point, and now the risk was not below here. Now the risk was here, only 13 pips. So you could almost take your 2 trades right there. Then after now the market went to continue rallying. As you can see, let me play this chart. The market almost went a lot of pips. A lot of pips. So you have to hold the price. And now when you try to manage these trades, you have to manage the trades based on daily time frame. You have to observe the shifts from daily time frame. You have to exit the trades if you spot a shift. So as you can see here on daily time frame, there's no any shift. The market was just performing, or the market was just printing some areas of liquidity, but the market didn't actually shift. So as you can see, the market continued to rally. But here on now, the market came and tried to perform a shift, as you can see here. So now this will be your exit point. Then after, you can find some opportunities on another formation that was here. You can now go to that series of finding some liquidity flow confirmations, as you can see on that point. So now actually from here, you have almost banked almost 1,317 pips. But here now, there's also some entries that you could actually take, but that entries are based on the second liquidity agglomeration that we are actually going to discuss today also. So that is how we trade these confirmations of liquidity flow. If there's any question before I go to the next example.
No, nothing yet.
Nothing yet. Okay, now let's go to another example. EuroCAD. This is the very, very important example because there are some cases that are actually happening that we have to address them. Let me clear it here. So as you can see here now, the market actually performed my shift on this exact point. And after that shift actually happened, this was my formation, the largest formations of them all. So now if I come to 1 hour time frame to find my shift on this exact point here so that I can confirm the liquidity flow. Now this was my 1 hour, or was my 1 hour time frame. Now when I come to this exact point here, as you can see, now this is a special case that I wanted to address it. As you can see here, the market performed a shift as usual. After market performing that shift, the market actually left us an inside formation that we have to use in order to confirm our liquidity flow. But now the problem is that the market actually came and consumed that area before even leaving the area of liquidity, as you can see. Do you see this? So now,
yes, I see it.
This is a problem. So on this certain scenario, when the market, if you remember, when I drew something like this on previous session. If the market actually performs something like this, then after the market came and consumed that liquidity, it's the same when someone draws you something like this. Because there is no liquidity here, that means there is nothing to offer. So now, if you find that your areas or your area of liquidity that you are supposed to wait for the market to confirm its liquidity flow, something like this happens, you have to find, or you have to confirm your liquidity flow by using a liquidity engineering downside that area. So as you can see here, this now is my liquidity engineering. So I have to use this as my tool in order to confirm the liquidity flow. Let me send another link. I can see I have less than a minute here. Let me stop it.
Okay.
And share the new link.
Okay, no problem, sir.